Hello, welcome all to our presentation on pairs trading called Pairs Trading, a market neutral trading strategy. And this will be presented by Mike Lee and myself, Brandon Kaplan, for FinTech 534 at Duke University. So we're going to start by just going ahead and diving right into the pair that we chose.
The purposes of testing our strategy, we decided to trade stocks of ExxonMobil and ConocoPhillips. As of October 2022, ExxonMobil was the biggest oil and gas company in the United States by market capitalization, and ConocoPhillips was the third biggest. The logic behind the choice of peer was straightforward. Often, intra-industry stocks will exhibit a reasonably strong correlation, say between 0.5 and 0.8, because the crux of pairs trading strategy is the correlation between the paired assets. That is to say, profits lie downstream of a strong correlation. We saw a pair with a correlation coefficient greater than 0.8. We thought ExxonMobil and ConocoPhillips would have a particularly strong correlation because, well, say, Meta and Google compete in the same industry. Their revenue models are diversified relative to ExxonMobil and ConocoPhillips. ExxonMobil and ConocoPhillips are both extremely reliant on the extraction and processing of hydrocarbons to generate revenues, and there is significantly less room for product differentiation between these two firms compared to Meta and Google. If something happens to the price of underlying crude oil, both ExxonMobil and ConocoPhillips will be affected very similarly. We calculated a 0.97 correlation coefficient between the two firms over the last 5 years. We chose a longer time frame to incorporate greater stability, capture market regime changes, and because our strategy relies on the assumption that the relationship between the stocks is mean reverting, we did acknowledge that this longer time frame would make our strategy less reactive to more recent changes in market conditions, but we believe the advantages outweigh this weakness. Moving on to the mechanics of our pairs trading strategy, a crucial decision is determining which security to short and which one to buy long. We short the outperforming security and go long on the underperforming one. By outperforming, we mean the security that has deviated more positively from its expected relationship with the other, based on our hedge ratio. Conversely, the underperforming security has deviated more negatively. Why do we do this? The expectation is that the outperforming security will decrease in value and the underperforming one will increase, thus reverting to their historical correlation. This way, we profit from both the short and the long position when the prices converge back to their historical norms. This strategy helps us capitalize on market inefficiencies and exploit short-term price deviations while minimizing risk. Now that we know which security to short and which to go long on, the next crucial step is to determine our hedge ratio. This ratio is essential for making our position market neutral. That is, we don't want our strategy to be affected by overall market movement, but only by the relative price movement of the two securities. We are protecting against market risk. This ratio aims to neutralize market risk and isolate the spread between the two securities for profit. To find the hedge ratio beta, we use regression analysis. In this case, the dependent variable is the price of XOM, and the independent variable is the price of COP. The slope of the regression line will be the hedge ratio. For our chosen pair of XOP and COP, XOM and COP, this comes out to be 0.929. This ratio tells us how many dollars of COP to short for every dollar of XOM bought, or vice versa. So what does this mean? When we go long on XOM and short on COP, for every dollar we invest in SOM, we would short $0.929 of COP.
So now we're going to cover the core of our strategy, meaning the signals that we would use to enter and exit the trade. So to do this, basically, in a nutshell, it's going to involve calculating Z-scores. We're going to standardize the spread between ExxonMobil and ConocoPhillips by calculating that Z-score over a certain time period. And in the case of this strategy, we use the same time period as the time period we use to calculate for our correlation period to just remain consistent. This helps us identify when the pair has deviated significantly from their historical correlation. So for the entry signal, we have defined threshold based on the Z-score. Specifically for ExxonMobil and ConocoPhillips, we're going to enter the trade when the Z-score either crosses 1 or -1, meaning you're 1 standard deviation above the mean or 1 standard deviation below the mean. So when the Z-score is greater than or equal to 1, we would establish a long position in ConocoPhillips and be short on ExxonMobil. Conversely, when the Z-score is less than or equal to -1, we're going to go short on ExxonMobil and long on ConocoPhillips. Now, this is because when the Z-score is greater than or equal to 1, that's a signal that ExxonMobil is relatively expensive, or in our prior language, outperforming compared to ConocoPhillips. And when Z-score is greater than, less than, or equal to -1, this suggests that ExxonMobil is relatively inexpensive or underperforming in comparison to ConocoPhillips. Our exit signal is also straightforward and follows from the prior calculation. We are going to exit the trade when the Z-score returns to what we determined to be a neutral level. And in our case, we chose 0 as the median between those standard deviations. This setup is going to ensure that we only enter trades when there's a significant price deviation and exit when that deviation is essentially corrected. That will thereby maximize our potential profits, and also at the same time, it should minimize risk. So in terms of our benchmark, we ended up choosing the S&P Global Oil Index. We chose this mostly to maintain relevance, as well as encapsulate a broad representation of the industry of focus, which is in this case is oil and gas. At the same time, this will also isolate systematic risk within the industry. And we'll in turn get a sense of how our individual stocks are diverging or not from the broader industry trends. Likewise, using the S&P Global Oil Index as a benchmark will help in comparing our returns, modeling the cyclical behavior of oil and gas stocks. Because if ExxonMobil and ConocoPhillips perform cyclically, then the broader index that encapsulates all oil and gas stocks will also perform cyclically. This serves as a sort of stable point of reference during what could be policy changes or volatile geopolitical events. So when we were determining our execution strategy, how we would actually make the trade, we obviously considered limit orders and market orders. Limit orders allow for better price control. They will reduce slippage and are generally more cost effective. The greatest downside here is that limit orders aren't actually guaranteed to execute, or if they are executing, they might only fulfill partially depending on the liquidity of the market. Market orders, on the other hand, are pretty simple, they're immediate, and they're also guaranteed to fill. The downside to a market order is that a market order is in fact vulnerable to slippage and in turn price uncertainty. In our strategy, we chose to enter the trade using limit orders and exit the trade using stop limit orders. And we chose this because limit orders lend themselves to being used in a situation when you have a very clear exit and entry strategy. And our z-score calculations that we've determined are in fact very specific entry and exit points. In addition to our spread analysis, because ExxonMobil and ConocoPhillips are large cap companies, their markets are sufficiently liquid, which allow for most retail traders to implement limit orders without too much concern for implement or partial fulfillment. So that was our presentation, and thank you guys for listening.